This is Alan Bush with ADMIS. In the stock index futures, we did see a bounce in the overnight trade. This linked to the People's Bank of China adding reserves to their banking system, so that seemed to stabilize global equity markets, at least in the Asian trade. However, it looks like these gains in stock indices are not following through. We're inclined to believe that the new fundamental now is that the quantitative easing is going to be taken away gradually. In fact, the consensus view now is that the Fed at their September meeting will announce that they are scaling back QE from $85 billion a month to $65 billion a month. And it also appears that they will completely end the program at their June 2014 meeting. At least that is the consensus view, which we would have to go along with the work that we have done there. So the possibility of less quantitative easing is the dominant influence. Of course, this is raising interest rates, and that will, I believe, put some pressure on stock index futures over the near term. Over in the currencies, seeing the dollar index trading higher now for the third day. This, of course, linked to the Fed's potential withdrawal of stimulus, which in effect raises interest rates. And of course, that's bullish for the US dollar from an interest rate differential point of view. Also, we are seeing some short covering coming into the Australian dollar. This after the Aussie dollar trading at a 33-month low against the US dollar earlier this week. We're inclined to believe that any gains in the Australian dollar will be temporary, and it is likely that we will see a new leg down for the Australian dollar. So the main trend on the AD is lower longer term. And credit markets, after two very severe down days, some short covering coming in today. We're inclined to believe that these gains will only be temporary and that the main trend now is lower for the credit futures market. In fact, we did have Treasury futures trading at a 22-month low with the weakness that we saw yesterday. There are risks, though, to the short side if there are any geopolitical events that could cause some temporary flight to quality gains to come into treasuries. But right now it does look like the dominant influence is the likely withdrawal of quantitative easing, and of course that would be a bearish factor for treasuries. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.